All right, good afternoon, everybody. This is Chuck Hughes. Thanks for attending. Thanks for the introduction, Tom. And I've got a great program for you today. I want to talk in general first about the market conditions over the last couple of years. And we've seen something that's kind of unprecedented from what I've experienced in my trading career, in that we've seen a lot of price volatility with very little trend. And I'm going to show you some snapshots of the S&P 500 index over different time frames over the last several years. And you can see that these snapshots have one thing in common: a lot of price volatility, a lot of wide price swings. But over that period that we're looking at, the S&P index was virtually unchanged. So you have a lot of volatility, but no trend, no clear trend. And that's been with us for several years now. So here's some different snapshots. This is from 2010. And again, you can see a lot of wide price swings, price volatility, but the index is virtually unchanged. And here's a different time frame. And this was really interesting, I thought. In 2011, the S&P started at 1257 and ended at 1257. So definitely there's no trend that year, last year. So the question is, how do you profit with this type of market volatility and but no real trend? And a lot of the major indexes are not trending, and but we see a lot of wide price swings. So if you're a directional trader, the problem is if you buy a stock or you buy a call option, if you use a money management system like I do, you could easily get stopped out with these kind of price swings before before the trade goes in your favor. So that's the real challenge with this type of market, is your directional trading. It's very difficult because you can easily get stopped out in just a day or two with these kind of markets. So what we're going to talk about today is spread trading, and the spread trading has allowed us to profit well during these kind of non-trending markets. And we use this in addition to our trade selection directional trades. Now, in previous seminars, we talked about trade selection, and today we're going to focus on strategies that, in conjunction with trade selection and a directional trade, can help you profit in these type of markets. So what we do in general, if we buy a stock and we have a profit in it, we'll normally either sell a call option against that stock to provide downside protection, or we'll buy a put option to protect that stock. And if you own a call option, let's say, you could sell a call option against your option purchase, and that creates a spread, and that allows you to profit in these types of markets where you essentially have no trend. So that's what we're going to look at today. And the spread strategies that have been working real well for us are the married puts, where you purchase a stock and then you purchase a put option to protect your stock. Covered calls, a lot of people are familiar with covered calls. Of course, with a covered call, you buy stock and you sell a call option. And then the third type of spread trade is option spreads. And if you buy a call option, you can sell a call option with a higher strike price to create a debit spread, limited risk debit spread. So those are the three types of spreads that have been working real well for us. And I just wanted to mention that these spreads work both ways. In other words, in 2008, we had a lot of these spreads on, but they were bearish spreads, and they worked real well for us. We we had really good profits during the last bear market. So I just wanted to mention that today we're more focused on the bullish spreads, but these have worked real well for us in the past with bearish spreads. So now the overall goal of the spread strategies is to increase the profit potential of a directional stock or option trade. And again, the way we do that, if we have stock, we can sell a call against that stock. If we have an option, we can sell an option against that option purchase. So when you do that, you increase the profit potential of your current directional stock or option trade, and we'll look at some examples of that here shortly. We also want to provide downside protection for our stock or option trade, and of course the way you do that is through a short call by selling a call or buying a put. And the short call or the long put, they profit as the stock moves lower in price, so that provides downside protection for your directional stock or option trade. And most importantly, it helps you maintain your position during volatile markets and wide price swings and avoid being stopped out of your position. So that's been real important these last couple of years. So what I did is I put together a real-time track record over the last 4 years, and I took snapshots of my brokerage accounts for the spread strategies and the trade selection strategies. And over the past 4 years, the combination of those two strategies produced over $4.4 million in actual profits. The average return was of the portfolios was 58.6%. Average day in days in a trade was 76. So an annualized return of 282%. I had 422 winning trades, 21 losing trades. So the overall percent of wins was 95.3%. And I make this this real-time track record available in a PDF in my books and websites. And here's just a couple examples of the portfolios. And this first one is an option spread portfolio, and this had profits of $175,000, average return of 95%. Here's an example of the buy right or covered call strategy, and this portfolio had $323,000 in profits, average return of 54.8%. Here's a directional portfolio. This is a stock portfolio, profits of $315,000, average return of 38%. And here's another directional trade portfolio. This was an option purchase portfolio using our trade selection process, and this portfolio had $254,000 in profits, average return of 114%. So you can see that the spread trades in combination with the directional trade strategies have been doing very well the last 4 years. So let's talk first about option spreads. And to create an option spread, you would buy a call option and then sell a call option with a higher strike price. And this creates a limited risk debit spread, and your risk is limited with this type of spread to the cost of the spread. So if the spread costs 3 points, your maximum risk is limited to $300. And there's two ways to initiate these option spreads. You can purchase a call, and then at the same time, simultaneously, you can sell a call option, or you can purchase a call option and sell a call at a later date. If you have a profit in that option purchase, you can sell a call at a later date to leg into the spread. So we do this both ways. We Sometimes I do it simultaneously. Sometimes I'll leg into a spread if I have a profit on an existing call option. And as I said, this works both ways. During the last bear market, we did a lot of bearish option spreads where we purchased a put option and sold a put option with a lower strike price. And that worked out real well for us during bear market, the last bear market. So let's look at an actual option spread trade I took. And my brokerage confirmations show that I bought an Apple 345 strike call at 28.17, and then about 10 days later, I had a profit in this call option purchase. So in these types of volatile markets, when you have a profit on a call option purchase, I like to sell a call against that. And I went ahead 10 days later, I sold the 375 strike call at 24.55. So the sale of this call, of course, reduces the cost basis of the option purchase. And I originally had $2,817 at risk. When I sold this call, that reduced my total risk to about $362. So right away, your risk is reduced considerably, and it provides downside protection. This spread trade provides downside protection in case Apple stock declined in price. So, of course, you don't have that if you just buy a call option and you don't have a spread in place. Then this call option could easily get stopped out with the wide price swings we've been having. So it's real important, I think, if you have a profit in an option or a stock, to go ahead and create a spread. That way, you not only increase the profit potential of your option or stock purchase, but you're also providing downside protection with this short call option here. So the advantages of the option spread versus option purchase would be an increased profit potential for your, we'll just talk about the option spreads for now, but you increase the profit potential of your option purchase, and many times you can increase this profit potential 50 to 100% or more. Of course, the option sale provides downside protection because that short option will profit if the underlying stock goes down in price, reduces your overall risk. You saw where we reduced the overall risk from $2,800 to $362, and it allows you, very important, allows you to maintain positions during volatile markets. So I was able to hold this spread during the volatile markets, and it ultimately was profitable. And the spreads can be profitable if the stock goes up or down. So what I like to do when I put these spreads on is I have option spread calculators, and we'll look at an example of one of those in a minute. But before I even put the spread on, I can calculate, what my profit potential is going to be for that spread, and also what the loss potential is based on the price of the underlying stock at option expiration. And we'll look at an example of the option calculator here shortly. And here's another option spread purchase I did recently. I bought the MasterCard 330 strike call at 23, and then about 11 days later, I had a profit in this call option, and because the markets are so volatile, I wanted to protect that call option profit that I had in that existing directional trade. So I went ahead 10 or 11 days later, I sold the 360 strike call for 20 points. So look at this. My risk went from $2,300 down to $300 because I sold this call option. And of course, when I sold this call option for 20 points, $2,000 in cash was credited to my brokerage account. So my total risk went from $2,300 down to $300. So that's a big advantage, obviously. And then again, the ability to maintain this long call option during wide price swings, that's also very important. And of course, selling this 360 call for 20 points, it helped me do that. So again, here's a snapshot of the option spread for Apple. And at the time that I created this spread with Apple, I had a profit in this, the 345 strike call purchase. I had a profit in that, but as soon as I sold this 375 strike call, I increased the profit potential for this option purchase by 110%. So that's obviously a big advantage too. So my profit potential went up 110%. I reduced my risk, overall risk, from $2,817 down to $362, obviously a big reduction in your total risk, and importantly, enabled me to hold this position during volatile price swings.
Chuck, a question for you that keeps coming up from a lot of the attendees. Is it atypical for you to put on a spread based on a premise of being long a naked call option, or do you tend to put on spreads and as one simultaneous trade, or leg into it as I just described?
Yes, Tom, I do it both ways, and the two examples that I just showed you, I legged into both of these, but I like to do it both ways. If I have a profit in a call option purchase, I'll go ahead and sell a call at a later date if I have a profit. I also will just initiate spreads where I buy and sell the call simultaneously. So I actually do it both ways. In the previous slide where I showed you my option spread portfolio, that was done. Most of those were simultaneous purchase and sells. So I like to do it both ways, and in my advisory service, we do it both ways too. Sometimes we initiate the buy and sell simultaneously. Sometimes we'll leg into it from a call option purchase. So
if the opportunity presents itself, if you're long a call option, it looks like the intrinsic value is going to make up for a lot of the downside risk, you go ahead and you sell that option against your long call.
Oh, yes. Yeah, definitely. In these kind of markets, you definitely want to do that. And that's worked real well for us, both, as you saw in my real-time trading and also in our advisory service portfolios, which I'll be showing you in a minute. Okay, and as I mentioned, I like to use the call option spread analysis calculator even before I take the spread trade. So I plugged in these numbers for Apple, and it's based on buying the 345 strike call at 28.17, selling the 375 call at 24.55. So I'm able to do this analysis before I actually take the trade, and this will calculate the profit potential for this spread trade at option expiration for different changes in the price of Apple stock at option expiration. And you can see in this calculator, I plugged in 20% increase in Apple, 15% increase in the stock, 10% down to 10% decline. So we can see if Apple stock increases at all, we have a 728% return potential. And the calculator will, it's based on the stock price. So if Apple stock at option expirations at 504, then the result is you would get a 728% return on the stock. So the calculator will calculate it based on the price of Apple stock. Now, if the stock is unchanged at option expiration at 4/20/20, then I still have a 728% profit. And if the stock goes down 5% or even 10%, I still have a 728% return potential for this option spread. So I was able to determine this before I took the trade using the calculator. And here's a snapshot of the option spread portfolio in my Inner Circle Advisory Service. And Tom, to answer your question, like these first two spread trades here, these were both initiated simultaneously. In other words, we bought the 530 call, sold the 570 call at the same time and created a spread. And in this one, we bought the 295 call, sold the 320 call at the same time. So these spreads were initiated simultaneously, and this portfolio is a mixture of spreads where we did the buy and the sell at the same time, and then other ones where we bought an option, had a profit in it, and then sold an option at a later date. And you can see for this McDonald's spread, we currently have 386% return for this McDonald's spread. For MasterCard, we have a 440% open trade profit. And for Verizon, we have a 340% return as of yesterday. So this just gives you an idea of the return potential for these option spreads, and you can see it's been doing well. We have a $102,000 open trade profit, average return of 139%. So despite the difficult market conditions, this option spread strategy is working really well.
Chuck, do you ever close any of the legs of the spread before expiration?
Yes, that's a great question. We do close out the spreads if we reach 90% of the profit potential. So in this case, let's just look at Apple here. The spread profit potential is $2,638. So if we get up to 90% of that, in other words, I multiply this profit potential by 90%. And in this case, it would be 90% of 2638 would be 2,374 or 23.74 points. So what I can do, Tom, is I can put a good to cancel order in to exit this spread if it reaches 90% of the profit potential. And as I said, in this example, I put that in at 2374. So if the debit on this spread gets up to 2374, then I just automatically exit the trade. And I can just put in a GTC order and just sit on it, and I don't have to worry about it, and just, I'll wake up one morning and it's, I'm out. So, and that's actually what I did with this spread to exit this spread. I put a GTC good to cancel order in. A lot of times you can get out way before option expiration and then go on to your next trade. So, yes, to answer your question, we normally will exit these spreads when they reach 90% of the profit potential. And here's another real-time portfolio snapshot for one of my option spread portfolios. Open trade profits of $175,000, average return of 95%. So you can see that these option spreads are working well in real time too. Oh, now I have two new picks for our audience here. This is a option spread trade. Now these are based on the price of Apple stock yesterday. Yesterday Apple closed at $429.11. So I've got two picks for you here. Option spreads. You can, based on yesterday's prices, the 410 strike call was trading at 30.70. So you could buy the March 410 call and sell the Apple March 4:30 call. And I think today you can even get a little better price because Apple was down a little bit today. So you can even get a better price than what I'm showing here. But I ran this through the option spread calculator last night after the close, and here's what we come up with. If Apple stock increases in price, this has a 69% return potential between now and March. So that's just a little over a 2-month period till March expiration. As a matter of fact, March expiration, I think, is the 17th. So this is about a 2-month trade here. So your profit potential is 69% on this spread trade. Even if Apple stock stays flat at 429, you have a 61% return potential. So this is all based on yesterday's prices, as I said, buying the March 410 call, selling the March 430 call. Here's another spread trade based on yesterday's prices. This is for Chipotle, buying the March 330 call and selling the March 350 call. And this spread has a 50% return potential.
Chuck,
okay, now we can talk about
the next slide. Again, another question that keeps coming up. Do you have a set percentage of capital that you allocate to each trade within your portfolio, or is it based on a premise of this is the trade now, this is what I'm going to go after, and I'm going to leverage or hedge myself based on a premise of where my other positions are?
Well, I usually will trade option spreads in an option spread portfolio. And whatever funds I have and I've allocated towards that strategy, I'll just usually normally use up those funds, and I'll spread it out with stocks in different industries. And but I usually allocate it by portfolio. So whatever I have in my option spread portfolio, whatever funds I have in there, I'll usually utilize that for the option spread strategy.
Okay, so you had segregated funds exactly meant for doing spreads.
Right.
Okay.
That's the way I like to do it. Of course, you can always mix these up in a stock account or an option account, stock purchase or an option purchase account, and these can be mixed up with those. I just like to do it for tracking purposes. I usually do one strategy in one account. So, but these are flexible. You can do several different types of trade in one portfolio. Okay, let's talk about buy-right spreads. And I just wanted to mention, in general, the buy-right trades cost more than the option spreads, because with a buy-right, you have to buy 100 shares of stock and then sell one call option. So depending on the price of the stock, these are costlier in general than the option spread. So you need a bigger account to do the buy-right spreads. So again, I have portfolios that are dedicated just to buy-right trades. And okay, so to initiate a buy-right, you'd buy 100 shares of stock and then sell one call option for each 100 shares of stock you purchase. And this creates a limited risk debit spread similar to the option spread, in that you can only lose the amount that you invest. And when you sell a call option against your existing stock position, this actually reduces your risk, and it's lower risk than just simply owning the stock. So this is a very, very low risk strategy, the buy-right strategy. Good place for a portfolio that you want to experience less volatility. And again, just like the option spreads, you can purchase the stock and then sell the call simultaneously, or you can purchase the stock, and if you have a profit in the stock at a later date, you could sell a call option to leg into the spread. And basically the same advantages apply for buy rights as we saw with option spreads. So in this case, we're comparing buy rights to just a directional stock purchase, and you increase the profit potential of your stock purchase because of the sale of the call option, and you get credited cash in your brokerage account as soon as you sell that call option equal to the amount of the premium. So you increase the profit potential of your stock purchase because you're receiving cash in your account for the sale of the call. And the option sale provides downside protection because the short call is going to profit if the underlying stock goes down. You reduce your overall risk because you get cash credited to your brokerage account for the sale of the call, and then it allows you to maintain your stock position during volatile price swings. And the buy rights can be profitable if the stock goes up or down. And again, this is a great strategy for volatile, non-trending markets. Now, here's an example of a buy right trade I did for Petrobras, and this was a simultaneous purchase of 300 shares of Petrobras at 23.08 and selling 3 Petrobras 25 strike call options at 6.58. So bought the stock, sold the options simultaneously. And I can also use this buy right calculator before I initiate a buy right trade. So before I took this trade, I was able to assess what the profit potential loss is based on various price changes for Petrobras stock at option expiration, from a 15% increase in price to a 15% decrease in price. And the cost for this buy right, even though the stock was priced at 23.08, after I subtract the premium I received for the sale of the call option, the cash premium, it reduces the stock price from 23.08 to 16.50. So 16.50 would be the break even on this. And we can see if the stock stays flat at 23.08, I'd realize a 39% return. So that's a great return for a stock being flat. If the stock goes up 10%, I'd have a 51% return on this trade. And if the stock goes down 15%, I'd have an 18% return. So again, this great strategy for volatile price swings, because you can just maintain your position if you have this downside protection from the sale of the call option. And this is another snapshot I took of my brokerage account, and this is a buy right trade for Mosaic, and I bought 1,500 shares of Mosaic and sold 15 call options. I believe these were the 40 strike call options for Mosaic. And what happened was, after I put this buy right trade on, the price of Mosaic stock went down. So you can see I have a loss here for the stock, but I have an overall $3,500 profit for this buy right trade because the option produced a $5,187 profit. So even though the stock went down after I bought it, I still have a profit on the buy right trade. So this is just a snapshot I took of my portfolio just to demonstrate how that works. And again, the sale of the call option provides downside protection and allows you to profit even if the stock goes down in price. Here's an example of a buy right portfolio, and I had profits in this portfolio, $323,000, average return of 54.8%. And you can see I'm diversified across different industries here in this buy right portfolio. Here's a snapshot of the Inner Circle buy right portfolio, and We have a $169,000 open trade profit as of yesterday, average return of 138%. And you can see in this portfolio we had on Baidu, this Baidu buy right, we have a 481% return, Caterpillar 286% return, Chipotle 767% return. So again, this spread strategy has been working real well in the current market conditions. Okay, and the last spread strategy is the married put spreads. And married puts are initiated by purchasing 100 shares of stock and buying one protective put option for each 100 shares of stock. So again, this is similar to the buy right portfolio. This requires more capital than the option spreads because you're purchasing at least 100 shares of stock. So here's an example. This is a brokerage confirmation. I bought 800 shares of the NASDAQ QQQ ETF at 54.35, and then I bought 8 of the January 55 puts at 4.11. So let's take a look at the math for the married put. And if you buy the QQQ at 54.35, buy the protective put at 4.11, your total cost for this married put is 58.46. So you have a cost of 58.46. Now, when you buy the 55 strike put, the value of that QQQ will not go below 55. So this kind of puts a floor in on the value of your stock. So the value of the stock will not go below 55. So I can calculate my maximum risk for this trade before I even take the trade. So we take the cost of 58.46, subtract the minimum value of the stock of 55, and we come up with a total risk of 3.46 points, which is $346 for each 100 shares of the QQQ, and that works out to about 5.9%. So before we even take this trade, I know my maximum risk, no matter what happens to the QQQ, is 5.9% in this case. And we calculate the break even for the married put by adding the price of the put option, in this example 4.11, and that would require a 7.5% price move in the QQQ to break even on this trade. So there's always a trade-off when you buy this kind of protection. So the QQQ would have to go up 7.5% in order to pay for this option at 4.11. So we can see maximum risk here is $346, and once we start, the QQQ starts going above 55, then this maximum risk of 346 starts to decrease, and then of course when we get to our break-even point of 58.46, then we become profitable if it goes above 58.46. And one of the things about the married puts that's different than the option spreads and buy rights is that your profit potential is not limited. So you can see your profit is just going to keep increasing as the underlying QQQ goes above 58.46. So there's no limit on your profit potential with a married put. So maximum risk 5.9%. Maximum return, it's unlimited. Here's some more examples of married put trades I did for emerging market index, small cap ETF, Apple, and Baidu. Now, once you initiate a married put trade, you have several choices in managing that trade. If the QQQ increases in price, a call option can be sold, which could guarantee a profit on your married put, depending on the strike price. Weekly call options could be sold against your married put, and I'll show you some examples of that here shortly. And On the QQQ, it generates about a 2% weekly return, and I'll show you how that works. So over the course of the 21 weeks, these options had about 5 months, almost 5 months to expiration, and over the course of that, if you take that 21-week period times 2%, you have a 42% profit potential from selling weekly call options against the married put position. And then the other choice, of course, would be just to hold the married put until expiration. And if you do that, then your upside return is not limited.
A few the attendees are asking, when it comes to the risk management of these, do you ever utilize any kind of weekly options, or do you specifically stay with monthlies and leaps?
No, with the married puts, I do both. I'll go with the weeklies, and I'll show you an example of that here in a second. I mix it up, just for diversification. Sometimes I'll sell weekly calls, sometimes monthly, or even longer term calls against the married put position. So that's a really low risk strategy, because you could see in this QQQ trade, my maximum risk is 5.9% no matter what happens. So if I sell weekly call options against that, I can generate some really good income, and at the same time, my maximum risk is only 5.9%. So this is a great way to generate income against a very low risk position. So let's say hypothetically the QQQ, you could sell the 60 strike call option at 7 points. If we sold the 60 strike call option at 7 points, of course, that would reduce our cost from 58.46 to 51.46. And then assuming the QQQ closed at 60 at option expiration, if you subtract, you'd be selling the QQQ at 60, because that's the price of the short call. So at expiration, if the Qs are at 60 or above, you'd be automatically selling them at 60. So if we subtract our cost of 51.46 from 60, we come up with a profit of 8.54, which is about a 16.6% return for the married put trade. And here's an example of weekly options I sold against the 800 shares of QQQ, and I sold 8 of the weekly options, 53 strike weekly options at 118 per option. And again, this option has a 1 week life. In other words, I sold it on Friday, and then the following Friday I either close it out or roll it over. So this is just a 1 week option, collected $929. And this was an at the money call. So this 118 was all time value. So when I sold this option, this time value, this 118, becomes profit at option expiration, because options lose all time value at expiration. So that 118 works out to about just over 2% time premium for that week. So if I multiply that 118 time value times 21 weeks, this had profit potential of 24 points, or 46%. And of course, you'd have to calculate in the cost of the put. This would reduce this profit potential by the cost of the put option. But that's a great trade-off to have, knowing you're only risking 5.9%, but you can collect 24 points or 46% over the life of that option. So that's a great reward to risk ratio, in my opinion. Here are some examples of weeklies that I rolled over. And with QQQ, I bought to close the September 23rd weekly option. This was happened to be a 57 strike, so I bought to close those at 3 cents. Then I sold to open the next week, which was September 30th, sold the 54 call at 127. So I collected 127 of time premium for that option. That was also at the money call. So this is a rollover. I bought to close the September 23rd, sold to open the September 30th. So that's what's known as a rollover of the weekly option. And here's another rollover, and I actually used a spread order for this rollover. I bought to close the Apple September 23rd 400 call, and then I sold to open the Apple September 30th, which again is a 1 week call, 405 strike call. So I actually rolled this over as an option spread order. Okay, and the advantages of the married puts is that your risk is strictly limited. This is the lowest risk of all strategies. Your risk is limited. A call option can be sold, which can guarantee a profit on the trade depending on the strike price. You can sell weekly call options against your married put. And again, it allows you to maintain your positions during volatile markets and avoid being stopped out. So when I initiated that QQQ trade, I knew my maximum risk was 5.9% no matter what happened. So I don't have to worry about being stopped out. I don't have to keep a mental stop in my mind. I just let the trade ride. And worst case scenario, I lose 5.9% and I can live to trade another day and take another trade. So it's a great way to reduce your risk with trading is with the married puts. And
Chuck, I don't mean to interrupt, but when going into this particular trade, do you do anything, or do you just let it ride to prevent yourself from being called out on the QQQs, as you mentioned before?
Well, you wouldn't be called out. What I do, Tom, is I do a combination. Sometimes I'll sell weekly options, sometimes monthly or longer, and then sometimes I'll just let the trade. I'll just let it ride till expiration, and and then roll it over. So again, I like to mix it up just for diversification and to reduce my risk even further. So I'll do a combination of weekly call option sells, maybe monthly, and then with some positions, I'll just let it ride till expiration because my upside's not limited. So if the stock really takes off, then you want to have some that your profits aren't limited, and just let some ride till expiration. And there's one other interesting twist to this married put strategy, and that is buying a dividend-paying stock and buying a married put with the idea that the dividend you receive from the stock will pay for a large portion of your put option protection. So this is a really low-risk trade. So what I did is I circled, here's an example of a married put on a dividend-paying stock. I bought Royal Dutch Petroleum. I bought 100 shares of the stock at 60.12 points, so 60.12. And then I bought a put option at 550, and this was the 60 strike put option at 550. So let's take a look at this trade. And these were all dividend-paying stocks that I purchased in this snapshot, along with the protective put option. So we'll look at a couple of these, and here's how this Royal Dutch trade worked out. Because I receive a dividend, in this case, at the time the quarterly dividend was 67.5 cents, and this had about 22 months. This married put had about a 22-month trade length. So I'm going to collect, based on this quarterly dividend, assuming that they keep up the dividend, I'm going to collect $473 here in dividends. And of course, that covers for a big part of the put premium, which was $550. So it almost pays for the whole thing. So $473 in dividends almost pays for this put premium. And if Royal Dutch stock over that 22-month period, if it just stays flat at 60.12, which was my purchase price, my maximum risk over that 22 months is only 1.4%, or $90. So no matter what happens, even if it goes down 50%, 80%, no matter what happens, my maximum risk on this trade is only 1.4%, which is pretty low for a 22-month trade. And then, of course, my upside potential is not limited, so if it goes up 40%, I'm still going to realize a 35.5% profit. Now, I don't realize the full 40%, obviously, because of the price of the put option, but I'm going to get a 35% return if the stock goes up 40%. So that, to me, that's a good trade-off. Here's another one of those stocks that was in that portfolio. Bought Bristol Myers at 25, sold the or bought the 25 strike put at 255, and my maximum risk on this trade was $108 or 3.9%, and this was about a 21-month trade. So again, very low risk over that 21-month period. Maximum risk of 3.9% or $108. Here's one more. This is for Duke Energy. And maximum risk on this trade was $133 or 4.3%. And this was about a 22-month trade. So very, very low risk strategy, buying these dividend-paying stocks and then buying a put option to protect it and using the dividends to pay for a big part of the put option.
Last question for you, Chuck, regarding some of the trades you just went over. Do you account for any slippage when it comes into these trades? Is it something that's just a matter of fact, or do you calculate that?
No, these are all liquid stocks, so your spreads to buy these stocks are in pennies. So there's really not much slippage with this. And these prices that I'm plugging into this calculator, these were my actual fill prices, from based on this brokerage confirmation. So these are all actual prices. But to answer your question, with these liquid stocks, Duke Energy, Bristol Myers, Royal Dutch, the spread is only pennies.
Right.
Yeah, their spread is literally only pennies. So it's not as much as a factor as it used to be.
Right.
It used to be a factor, but not anymore. And here's the Inner Circle Mary put portfolio, $82,000 in open trade profits, average return of 53.8%. And here's, I wanted to show you, I guess I don't have that, but I wanted to show you some individual examples for some of these trades. And a lot of these trades are going to produce a substantial profit no matter what the stock does. In other words, we bought the stock, and then we had a profit in most of these, and then we went ahead and bought a put option for protection at a later date. And a lot of these have a 50 to 60 to 70% minimum return no matter what happens to the stock price. So I meant to put some actual examples of some of the individual trades in this portfolio, but I forgot to include them, but a lot of them will have a 40, 50, 60% minimum return no matter what happens to the stock price. And that's over, most of these are a 1 or 2 year period. So over a 1 or 2 year period, no matter what happens to the stock, you're still going to make 50% on some of these trades, and your upside potential is not limited. So if these stocks keep rolling to the upside, that your profits will also increase as these stocks move to the upside, because the upside's not capped and it's not limited. So overall, very, the lowest risk strategy we have. Okay, that concludes my presentation for today. And in my Inner Circle website advisory, if you log on to chuckhughes.com and click trade results, you'll see the current trade results for these various strategies, and that's updated every month. We have both the open trade results for the various portfolios, and we also list the monthly closed trade results. So if you want an update on how these various strategies are doing, whether it's the married put or the option spread or the buy right portfolio, if you just click trade results, we'll have the trade results. It's usually as of the first trading day of each month, so we keep that updated, and you can see how the various strategies are performing. So, and if you're interested in the Inner Circle, you can log on and contact us, or call our sales partners at this toll-free number, 866-661-5664, or 310-647-5664. So I want to thank everybody for attending today, and I'll be glad to answer any questions.
Yeah, Chuck, we appreciate you coming out. I mean, based on the premise of how the markets have traded over the last year, and I know a lot of people lost a lot of money, etc. Is there any last or parting words you have, or any kind of indications moving forward for 2012, and how do you feel about it?
Yeah, I'm very agnostic when it comes to predictions, but I would say in general, I'm really optimistic for 2012. Stocks for the last 11 years have been way underperforming under their average return, and if we were just to revert to the mean for profits, we'd get a 22% return over the next 10 years just to revert to the mean for the previous 10 years. So I'm optimistic going forward about the stock market in general. And of course, I just follow my trading systems, and I'm a system trader. So I normally don't base any of my trading decisions on my predictions, but I have a prediction just like anybody else, and I'm optimistic going forward as far as U.S. stocks go. I see real high quality growth stocks, trading at very low PEs, historical PEs, and I think if you buy these high quality growth stocks right now or call options on them, I think you'll get a really good return going forward. And I'm talking about stocks like Apple and Google and Chipotle, MasterCard, great quality growth stocks with great potential, but they're still trading relatively cheap compared to historical norms. And I remember in the 80s and 90s when we would look at a quality growth stock, and we'd be glad if the growth rate was about equal to the PE. Usually the PE was 2 to 3 times bigger than the growth rate. But today it's just the opposite, and the growth rate is 2 to 3 times the PE. So I think there's a really good future going forward with the high quality growth stocks.
Great. Thanks, Chuck.